Now to help us focus on the fundamentals behind the technicals, Tom Kloza joins us, Global Head of Energy Analysis at Oil Price Information Service. Tom, welcome. Good to have you back. Just looking at how, well, even amidst the turmoil, war in the Middle East, crude prices have remained relatively contained, a reflection of how the involvement from some of the other major players on the production side has been relatively limited as well so far.
Yeah, Ben, and I would also note that when we had the Hamas bombings, that occurred against the backdrop of refineries really in a heavy maintenance season. We probably had 3 million barrels a day less crude oil demand, and we've continued with that since October 7th because we've got such heavy maintenance taking place in the United States and all over the world. So the real showdown for crude fundamentally is going to come in the middle of November when all of these refineries come back. And if you splice in some winter demand, you could probably make the argument that it's a little bit of a coiled spring for crude oil, and that the typical seasonality, which sees prices drop from the end of the summer into the depth of the fall, may not be operating here. And of course, there's more geopolitics for oil than there is for every other commodity combined, probably.
I want to get back into that final part of that statement in just a second, but I really like the point you just made in terms of less demand, because it seems like during the run-up to 95, everybody was focused on production cuts. So that does get countered if demand falters, right? Higher rates ultimately. And speaking of the bearish narrative, I mean, there's been a few factors that have been contributing to this move off that 95 level. You had just this week, I think it was comments from the IEA or the EIA, I can't remember which one it was, but they were talking about how, again, that basically we're seeing record production here in the U.S. Above pre-pandemic levels.
Yeah, record production in the U.S., and we're getting additional barrels from places like Guyana, Brazil, and, up until recently, obviously, Iran was able to move oil up, sometimes under the auspices of it being sold in Malaysia and things like that. But again, we're going to see demand for crude go from about 15.5 million barrels a day in the U.S. to over 17 in December as everybody ramps up. And that's going to be the test for the market. And it'll particularly be a test if there's more suppression of Iranian oil, which is a possibility, but not necessarily a probability now. And the whole deal, the side deal with Venezuela on the elections, looks like it's falling apart. So we were counting on maybe another 200,000 barrels a day of Venezuelan oil in 6 months. And, they're treating their elections like Chicago used to treat elections back in the 50s, I suppose.
Well, vote early and vote often, as far as I remember, was the motto, right?
And dead people can't vote. Yeah.
Talk to me, Tom, about, in addition to the bearish factors we just mentioned, we also have the EIA build in inventories this week. You've got the dollar, which has been, coming off a bit here since. It's, rallying, I should say, back to 107, coming off a little bit more recently since with the Fed, but that move to 107 seemed to weigh on crude a little bit. During the period that we were running up to 95, I remember a lot of calls for $100 triple-digit barrels of oil, Tom. I also remember Citi coming out and somewhat counter trend saying, look, no, tying to your demand concerns and the point you were making earlier about, they were saying, look, we could see $70 a barrel of oil. I mean, we're kind of hanging out right in the middle of that range, right? At 85-ish, we'll call it. Where do you see us, 70 or 100 next?
Well, I do think we're close to that coiled spring. And, the Department of Energy says they'll buy some sour crude for about $79 in January and February in the first 5 months of the year if prices get there. And, when they made that announcement, people thought it was ridiculous. The reality is if they didn't specify that it had to be U.S. crude, they could be buying Canadian crude in spades for much under that price. So I think that kind of puts a backstop in on the crude oil numbers, and I'm a little bit surprised. I mean, look, to be looking at crude oil numbers that are $1.50 or $3 lower than they were on October 6th before the Hamas bombing, I think that's a bet that many, many people would not have made. So I do think there's potential for them to go higher. The other side of it, and I think people have to realize this on the consumer side, is gasoline looks to be just a dog well into the winter. When those refineries come back, we're going to be making too much gasoline in the winter when, demand tends to go down to about 8 million barrels from 9 million barrels a day. So I kind of disagree with some of the prognostications for 2024, where you're going to have average gas prices of $3.90. I think it might be $1 below that, and that can be a drag on crude. I mean, right now, believe it or not, in the biggest bulk market in the world, the United States Gulf Coast, refiners making gasoline are losing money on every gallon of gasoline they're making. They're making enough money on diesel and jet fuel to offset that. But I don't think I've ever seen gasoline being a loser for as long a period of this without COVID or something like that in the backdrop.
We keep a close eye on crude and RBOB, and I've got them here actually side by side. We recently saw crude run up into that $95 level, yet RBOB limited in terms of participation. We were talking about that divergence between prices at the pump and what we were watching as far as the run up there. I did want to get your thoughts on China here. We're a little short on time, though. I apologize. It seems like the data has been somewhat soft and kind of feeding into that bearish narrative as well. But Tom, always appreciate you joining us here. It's great to have you back on the show, and thanks for joining us here this Thursday morning. Tom Kloza, Global Head of Energy Analysis at Oil Price Information Service.